A big week ahead. The ECB on Thursday and the inflation report on Friday from New York City this morning. Good morning, good morning. Equities elevated. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue. It's good news, bad news.
The market wants the Fed to slow down.
It's all been about these great job numbers and how good that is.
But that does present risks.
This is where we see the overheating of the U.S. economy happening.
Slowdown here is a good thing.
That jobs number on Friday was stronger than the consensus.
What this number tells the Fed is go ahead and keep hiking rates like crazy.
They've got to pivot to talk about the sustainability of the economy.
The labor market is too tight.
They do need the labor market to cool.
We're looking for reasons to find a slowing of the economy.
It allows them to be a little less hawkish, which again allows for that soft or the softish landing.
That's a little bit tricky of a message for them to say.
As we move forward from here, inflation is going to continue to be a problem.
Too much of a good thing is actually a bad thing.
Joining us now, Crossmark's Bob Dole, Victoria Greene of G Squared. Let's start with that line from Jeff Rosenberg over at BlackRock. Victoria, your view, is too much of a good thing a bad thing?
Yes, I mean, the jobs report wasn't great for anything if you're hoping that for a Fed put. I mean, don't fight the Fed here. They're going to hike. And I feel like right now we're like in a slow motion car crash. Just the question is, how bad of a car crash is this economic slowdown going to be? And I really don't see a way of a soft landing, but strong jobs reports. We'll see what inflation says on Friday. I mean, the Fed's got a green light. We already know June and July are 50 probably. September's looking like 50. You know, you're looking at a 3.25 terminal rate at the end of this year. At some point it'll roll over, but the Fed needs to put as much space between zero and where they have rates so that they actually have some tools to help maybe make it a soft landing.
Hey, Bob, are we back to that old, all-familiar playbook of a few years ago?
I think that good news is bad news for multiples because it means more pressure for Fed to raise rates, more pressure on PEs. But let's face it, good news is good news for earnings. And that's the battle the market's moving into. Do we need to worry about multiples anymore, or have they bottomed and now we have to worry about earnings? That's the trade-off.
Do we need to worry about earnings then? Mike Wilson over at Morgan Stanley thinks we do. He wrote earlier this morning the following: the bear market rally that began a few weeks ago can continue for a few more weeks until the Fed makes it crystal clear they remain hawkish and earnings revisions fall well into negative territory. That should ultimately take the S&P 500 towards 3,400 by the middle to late August. Bob Dole, your view on the line from Morgan Stanley?
I think it's on the pessimistic side, but if we get a recession, they'll be on target. My view is we got a chance of skating through this. That doesn't mean earnings aren't at risk, but perhaps not to the levels that Morgan Stanley is worried about. Year to date, as you know, despite the economic concerns, earnings estimates have moved up. Perhaps they started the year too low, but holding sort of 230 for the S&P earnings this year and 250 next year. We're going to have to watch that like hawks.
Victoria, you're not a million miles away from Mike Wilson and Morgan Stanley. You don't think we've seen a bottom. You would call this a bear market rally, wouldn't you?
Yes, I do. I think that earnings are going to come under pressure. Ex-energy, I actually think you're going to see a lot of revisions, especially in like the S&P 500 being cap weighted and so heavy to tech. We know rates are coming up. We know we have quantitative tightening coming. This is a hard environment for growth companies to continue to outperform and to grow their earnings expectations. I do think you're going to see some downward revisions. And while the PEs have moderated kind of back more towards normal historic PE levels, what happens when that E portion starts to drop? And I think it's going to be very difficult in an inflationary environment with such a tight labor market, and you're still having supply chain issues, and the consumer is under so much pressure. I think it's going to be very difficult to see a very broad-based earnings growth into Q2 and Q3. Not to say that certain companies can't outperform, but I think just if you look at economic growth broadly and how U.S. companies are going to be able to grow their profits, there's so many pressures on margins. And listen to the CEOs. Almost every financial CEO and Elon Musk are talking about the risks they see in the slowdown. I mean, Jamie Dimon saying it's a hurricane, Elon Musk saying it's very bad, and starting to look at cutting labor. You have to look at those and think that the sharks are circling a little bit and the world's going to get harder.
Elon Musk has got a super bad feeling. He's got a few other things to say as well. Let's get to Abigail Doolittle for that. Morning, Abby.
Hey, John. Well, yes, we do have explosive headlines coming out of an amended 13D filed by Elon Musk regarding Twitter. He is saying in this amended 13D filing that he believes Twitter is breaching their merger agreement by not providing information about spam and fake accounts. Musk said he believes Twitter is, quote unquote, actively resisting and thwarting his information rights by refusing to disclose the information. It goes on to say that Musk says he reserves the right to terminate the Twitter merger pact if breached, and again saying that this thwarting of information is a breach. And of course, if you recall, John, when this first came out a couple weeks ago, Twitter said that it would be a breach by Elon Musk if he doesn't go through with the merger based on these spam accounts. Now his lawyers are going on the offense. Musk lawyers delivered a letter to Twitter legal officer. So this situation getting more contentious, and that spread between the $54.20 bid and where it is right now, basically a $16 gap. So this story continues, John.
And that's the Twitter story. Did we get any clarification whatsoever on the story pushed by Reuters on Friday that he was considering job cuts at Tesla?
He did backtrack a little bit on that regarding on Saturday, John, when he came out and provided less clarity, saying in terms of whether or not there would be some sort of 10% staff cut. So backtracking a little bit on that bearish view, and not so surprisingly, a little bit of a murky quality to his leadership at sometimes, but nonetheless, he has that Elon Musk fan superpower that continues to follow him, John.
Abby, thank you. Twitter down by 5.4%. We're seeing job cuts across tech. Propositions for more cuts still to come. The pressure's building, we know that. This is the take from D.A. Davidson's Tom Forte. He says the following: they're no longer sure bets. There's a number of fundamental things working against them. That's the view on some of these big tech names. For more, let's get to Kaylee. Hey, Kaylee.
Hey, John. Well, just on that Tesla story, I don't think anyone other than Elon Musk really knows what's going on with that company's workforce in particular, because after that Reuters story that you mentioned, Elon Musk was out on Twitter on Saturday saying that actually the salaried headcount is going to stay relatively unchanged and they'll actually be adding to their workforce over the next 12 months. So investors trying to figure out what to do with all of that after a 9% decline for Tesla yesterday. The stock is up, or Friday rather, the stock is up 3.5% in pre-market this morning. Now, whether or not Tesla is or is not cutting jobs, there is a laundry list of other tech companies that have either paused hiring or are cutting back on their workforce, from Snap to Robinhood to Netflix, Twitter, Meta, others. According to layoffs, FYI, more than 126,000 technology workers have lost their jobs since the beginning of the pandemic. It really speaks to a new reality across the tech landscape, John. After decades of astronomical growth and easy money and soaring valuations, things are now turning the other way. You're seeing a slowdown in hiring, slowdown in growth, with companies slashing projections, shelving expansion plans. And as rates go up, investors are less willing to pay really high multiples for these stocks. We've seen that reflected in a 23% decline year to date for the NASDAQ 100. The communication services sector, which houses Alphabet and Netflix and Meta, is down by a quarter. And then if you don't make a profit, if you are a profitless tech company, you have really taken a battering. That group of stocks has lost almost half its value so far this year, John.
Kelly Lyons, thank you. Kelly, going through some of those names. Kurt Wagner over the weekend did a great job of this over at Bloomberg. Snap cutting sales and profit forecasts. They said it was slow hiring. Lyft said it will bring on fewer people and look for other cost cuts as well. Microsoft hitting the brakes on hiring in certain divisions. We've heard from Instacart dialing back hiring. Amazon, that was a takeaway for me over the last 3 months. Amazon turning around and saying we've got too many workers, too much space. Bob Dole, what's your reaction to that when you hear those names in that industry saying those things?
Yeah, problems in our economy. We remember last year, 1984 was the last time we saw economic growth as strong as that. To have the economy slow, no surprise. Then you layer on top of it the inflation problem, the rate increases, the economy slowing, and inevitably that has top line cost pressures below the line, and companies are having to retrench. We will have some layoffs. Look, the Fed's trying to eliminate some of the jobs that are unfilled. That is twice as many as people looking for them. That's what they're really working on. But inevitably, we will cut jobs as a result of Fed increase in the rates and economy slowing.
Victoria, your view on the same thing?
Sure. I think they're also trying to build in flexibility. I think everybody's concerned about what the next 12 to 18 months will bring, rising rates, a tighter market, a slowing consumer potentially. So I think some of this is also a little preemptive to give them that flexibility on margins and to kind of warn that and set some expectations. It's really hard when earnings expectations are so high, but you're concerned on a slowdown. So I think some of this is companies really trying to set this expectation of rough sailing ahead. And it is. I mean, there's no way around the fact that the goal of the Fed is to slow the economy and to slow the job market. And that means that more people are going to be out of work at a very bad time to be out of work. If you look at the pricing pressures on housing and rent, you look at the grocery store and you look at the gas station, I mean, we're at like 482. I think. I don't know. I checked it 30 minutes ago. It's probably 5 cents higher by now. I mean, gas prices are just insane. So I think you need to listen to what the CEOs are trying to tell you right now, which is they are worried about growth.
Victoria Greene alongside Bob Dole. Sticking with us, your equity market looks like this going into the open. And Bell equity futures higher by more than 1%. Twitter a name to watch. That stock is down by more than 5%. Abigail, that's the stock to watch going into the open.
Twitter really is the stock to watch on the open and down, as you mentioned, about 5%. This, of course, as these big explosive headlines are coming out from Elon Musk, an amended 13D filing, basically saying that he reserves the right to cancel his bid that in that amended 13D filing that Twitter is breaching their merger agreement by not providing information about spam and fake accounts. He believes Twitter is actively resisting and thwarting his information rights by refusing to disclose the information. And again, he reserves the right to terminate that Twitter merger pact if breached. So this contentious situation continues. More headlines most likely to come out in the future. But this is what we know right now. And again, the gap between that bid at $54.20, very, very wide here by about $16. As for some other movers to the upside, because we, of course, John, have the NASDAQ 100 outperforming, Apple up 1.2%, even with yields higher. This, of course, as the worldwide developer conference this week, the focus on their virtual reality headset. iPhone revenues seen up 6.2% this year after up 39% last year. So they are clearly trying to diversify. Amazon, take a look at that, John. No longer a $2,500 stock, now a $125 stock, up 2.4% on the 20-for-1 stock split. Tesla, to the point that you and Kaylee were making, up about 3.7%. This is as Elon Musk has reversed his job cut call. Some real murkiness there. So Elon Musk really in the news this morning. And then finally, DD Global soaring. Take a look at that, John. It's a $3 stock, but nonetheless up 66%. This is China is to end the probe and allow the rideshare giant back onto its apps. Never a dull day, John.
Never. Abby, thank you. Equities up. Coming up on the program, the Biden administration looking at lifting tariffs to tame inflation.
There are other products, household goods, bicycles, etc., and it may make sense.
That conversation up next.
Steel and aluminum, we've decided to keep some of those tariffs because we need to protect American workers and we need to protect our steel industry. That's a matter of national security. There are other products, household goods, bicycles, etc., and it may make sense.
The Biden administration reassessing certain elements of foreign policy to alleviate price pressure at home. VTOL Group suggesting Iranian oil could be the answer. They said the following: if the midterms are dominated by the need to get gas prices lower in America, turning a somewhat greater blind eye to the sanctioned barrels flowing out of Iran is probably something you might expect to see. Joining us from D.C., Emily Wilkins. Morning, Emily.
Good morning, John. I mean, yes, this is sort of speaking to the overall problem that the Biden administration is really facing here with inflation. There's really only so much that they can do. It is a global issue, and you have seen them try to address it at home with various measures. They say they have more legislation coming that could potentially address this. But you have a certain point where this is going into the relationship that the U.S. has with other nations like China, like Iran. And it's coming at a time where they're trying to figure out out how to navigate some of these relationships that have a very contentious aspect to them. But they do need to try and figure out a way to lower prices for the American people, because that is really the front of mind issue right now for Americans and is set to be the big issue that drives the elections in November.
Emily, it's pretty obvious just from us observing what's happening right now. There's some tension between the foreign policy goals and the pressure they have domestically over inflation. It's interesting to hear Secretary Raimondo say those things about removing some tariffs on Chinese goods, something they're considering. And at the same time, Secretary Blinken just last week said this: China continues its genocide and repression of predominantly Muslim Uyghurs and other religious minority groups. How will they reconcile any move on tariffs in China with the language coming out of the State Department?
It's a difficult thing to do, particularly as the Biden administration is trying to move to make sure that any products coming out of the Xinjiang region don't go to the U.S. I mean, that is not an easy thing because so many of those products go through other pathways in China. And so there is a huge question mark right now. How firm do you push back against China's human rights abuses versus how much do you try to make space for trading, for tariffs? And how do you think about how this is impacting Americans? I thought it very interesting that Secretary Raimondo said right up front, we're not going to have, changes in tariffs on steel and on aluminum because we know that that protects American workers. But then go on to say that not every industry has benefited necessarily from those tariffs. And, the Biden administration, they have been looking at those tariffs that the Trump administration put into place for quite some time now, trying to figure out what that relationship needs to be. But we really haven't seen any final decisions on how to move with those tariffs. And this might be sort of one area of pressure, is how do you deal with inflation? How is this impacting the American people?
Emily, thank you. Emily Wilkins on the latest. One other thing we've heard a lot of as well is this line, the Fed is independent. Lisa, Tom and I were talking about that in the previous hour. We've heard that a lot from this administration. The Fed is independent. The Fed is independent. At the same time, you could argue, as they say that, ultimately they're setting this Fed up to take the blame for what's happened with inflation. They're independent. They get to decide. They need to address it. We believe that they will. It's their job and perhaps not ours so much. That's one view, one argument. Peter Cheer of Economy wrote the following. He said, it's clear that DC is focused on inflation and midterm elections. Yes, the Fed is independent and prizes its independence from politics, balancing jobs versus inflation. But there seemed to be intense political pressure to fight inflation and send that message. That's a view from Peter Cheer. Bob Dole, Victoria Greene back with us. Victoria, you like energy. You like the likes of Devon over, say, an Oxy. Can you walk me through first why you like energy and why certain names over others?
Yeah, so I really like the U.S. E&P space, especially those with a very strong position in the Permian Basin with very low break-evens, and they're cash flow and shareholder friendly right now. They're doing a lot of fixed plus variable dividends, and you're not seeing a huge growth in CapEx. You're not seeing wildcatting. You are seeing a slight growth in rig count. We're still below pre-pandemic, and we're still well below. We're at like 780. We're still well below about the 2,000 rigs we had back in 08 and back in the early 2010s when oil prices were back over 100. So I look at some of these U.S. producers, and I think they've got a long runway. Even if oil comes back down to the 90s, we were talking about Iran. I think they've got something like 100 million barrels of floating storage that could easily come to market. OPEC is starting to increase their supply cuts and get back to normal for them. But you're still seeing an undersupply geopolitical, and you're not going to see Russian crude come back anytime soon. Maybe to India, maybe to China, but nobody else wants to deal with Russian crude. You can't even find people to unload it. So we are looking to potentially dance with some less savory characters. If we go back to Iran or Venezuela, I think we have to be extremely careful. Europe is a good case study of sometimes doing business with, can we just say, frenemies, like not really friends, but maybe not an enemy. Your Irans, your Venezuelas, and in some regards, your Chinas. It can put a lot of pressure on the relationship, and it can be a huge supply disruption if that relationship fractures. So focus U.S., low break even, shareholder friendly. You got to love the energy space right now.
Bob Dole, can you get on board with that?
Yes, coming into the year, it was one of our two favorite groups. Still like it. I'd like to buy more, but I'm going to try to be pricey and do it on a pullback. But the energy story is not over. And that is part of the inflation problem. It's part of the politics related to November. It's front and center inflation, and energy gas prices among all those are right at the top of the list.
Bob, that's what I wanted to get to. If it's part of the problem, it's the solution to turn this around and head in the other direction.
Well, first of all, as you know, inflation, at least so far, peaked a couple of months ago. I think it will continue to fall irregularly for the rest of the year, but to still unacceptable levels. So there's more work to be done. Look, I think, I'll try not to be political here, the president could turn on some spigots in the U.S., pipeline permits to drill, et cetera, that could help over time our problem of rising energy prices. But of course, they're trying to force a transition where you, I, and everybody else buy an electric car.
Are you doing that, Bob? You buying an electric car?
Not yet. Not yet. I'm still waiting for you to do it.
You're holding off. I don't drive, Bob. I live in New York. I'm lucky. I don't have to. But for others, that's an expensive one. Victoria, is the success of those names that you like, do they become a target? Do they have a target on their back because of that success that you described?
No, I mean, if you look at their PEs, because they're making so much more money, they're still very much value stock, trading about 10 times multiples. I do think the administration and the oil and gas industry do not have a good relationship. I'd love to see that get worked on a little bit more of how they can come together. They are barely speaking to one another, so that would be a good first step. But I don't think it's a bad place to be, especially, even though Devon was the best performer in the S&P 500 and they're all up 50% plus this year, because of their growth of earnings, they're actually still fairly moderated price-wise. So I'll take my 12% cash flow yield. Most of them that's about where they are with the fixed plus variable, and hopefully I'll get some price appreciation. But the crude story is not going away anytime soon because of the geopolitical disruptions. And again, even if we found some spigots to turn on, it's a very large lead time. You have refining capacity issues. You had a very interesting comment from Chevron CEO, I think last week, who said there may never be a new refinery built in the U.S. And in a little bit, some of these policies are eye-opening, and they're not an easy fix. We can't just conjure up more refining capacity. We can't easily move large amounts of oil and gas around. But the lead time in developing these projects are decades. And so you have a lot of people pushing back saying we do not want to invest in huge projects right now because we don't want them to be obsolete in 10 years or to have a policy shift and suddenly we can't make our money back.
Victoria Greene, Bob Dobb, to the two of you, thank you. Big week ahead of us. Your morning call's up next, and later, Elon Musk calling Twitter out, saying they've breached the merger deal. That stock is down 5%. Minutes away from the opening bow, stocks up higher. Here are your morning calls. First up, Edward Jones upgrading American Express to buy with recent initiatives boosting growth in new accounts. Morgan Stanley upgrading CrowdStrike to overweight, saying the company offers durable growth and free cash flow at a discount. And finally, Raymond James upgrading Spotify to outperform, with the majority of bad news now priced into shares. Coming up, UBS's Stuart Kaiser joins us at the opening bow, making the case for big tech. 25 seconds away from the opening bow this morning. Good morning to you all. Coming off the back of a week of losses, Friday responsible for the bulk of that, looking to take a bite out of it with futures higher by more than 1% on the S&P, on the Nasdaq 100 up 1.5%, on the Russell up by 1.12%. That's the opening bow. Switch on the board and get to the bond market. Yields just a little bit higher through much of this morning, up by 3 or 4 basis points to 296.99, 320 at the start of May. We backed away. Then we had a lift of 20 basis points there and thereabouts through last week. So that's a bounce back on a 10-year Treasury yield. In crude, we come very close to 120. Then we keep backing away. Again, 119.66, getting closer. Called it 119.70, up by 0.75% on the session so far. And looking ahead to the ECB on Thursday, euro dollar 107.10. We're negative 0.1%. The likes of Bank of America think we could get 2 50 basis point hikes from this ECB later this year. Just think about how much has changed with this ECB. I've talked about it repeatedly through this morning. We've gone from negative rates since 2014, no rate hikes since 2011, to a conversation about 50 basis point moves off the back of the inflation story. About 45 seconds into this session, equities looking okay. With a breakdown, here's Abby.
John, a very solid stock here for stocks on the morning. All 11 S&P 500 sectors higher, with that index up more than 1%. One stock not helping any indexes, though, of course, Twitter, the top stock this morning, a top stock story, I should say. This, of course, is explosive headlines are coming out of an amended 13D filing by Elon Musk, saying that he believes Twitter is breaching their merger agreement by not providing providing information about spam and fake accounts, that they are actively resisting and thwarting his information rights. He reserves the right to terminate the Twitter merger pact if breached, if that is proven. And Musk lawyers have delivered a letter to the Twitter chief legal officer. This, of course, is a very contentious situation, John. Not only have these headlines come out, but if you recall a couple of weeks ago when the initial idea was floated that he may not, when he might end the bid around these fake accounts, Twitter came out saying that this would not constitute a breach. So real contention here. Of course, Twitter shareholders also suing him, claiming he manipulated Twitter shares. Twitter shares are down 15%, of course, since all of this has come out, since he first made that bid, never making that $54.20 share price bid. That spread continues. Lots more to come here, John.
Abby, thank you. That stock is down by 4.5%. If you're just tuning in, the latest filing from Elon Musk claiming a lack of info on bots is breaching the merger agreement. Kelly Lyons, what do you make of this one?
The saga goes on, John. I think there's serious questions around whether Elon Musk even wants to buy the company, or at the very least buy it at the price that he offered. Of course, he has made a very large issue about these spam and fake accounts. He wants concrete evidence that they make up less than 5% of all the accounts on the platform. And the direct quote for you from this 13D filing is that Twitter's failure to provide this information is a material breach of Twitter's obligations under the merger agreement, ... This means that he has the right not to consummate the transaction and his right to terminate the merger agreement. Hence, this is why Twitter is down at the opening bell. As Abigail said, the spread between what Elon Musk offered, $54.20 a share, and what the shares are trading at remains quite wide. It's around $16, but it's worth noting that it was nowhere close even before these headlines came out. There has long been uncertainty in this market as to whether or not this deal was going to actually go through. And we have to keep in mind, and Abigail mentioned this, Twitter is down significantly since Elon Musk announced his 9.2% passive stake in the company, which of course is no longer passive. It's down about 12% since he made this $54.20 offer price. The NASDAQ 100 as a whole down about 11% since that date, April 14th. And of course, they're all much lower on a year-to-date basis. So valuations for tech broadly have come in, and now maybe Elon Musk is questioning whether he really wants to pay $54.20 a share for this company. John, I'm not going to speculate. I can't pretend I can get inside Elon Musk's head.
No, and you shouldn't even try. The market's speaking for itself. Katie, thank you. 38 on the stock, $54.20 the agreed price. That's a wide spread. That's Twitter. Tesla moving the other way. The stock's up by more than 3%. You remember the news on Friday. Someone had a super bad feeling, was talking about job cuts and all of that. This is what Elon Musk tweeted over the weekend. Total headcount will increase, but salaried should be fairly flat. Taylor, I'll ask you the question I asked of Katie Lyons on a different name. That was on Twitter. This is on Tesla. What's going on here?
Well, the good news is I actually spoke with a few analysts about this Friday during BTech, and they say that actually for Tesla, the salaried headcount, it is a little confusing given that this is a company in hyper growth mode. But I think the good news is that maybe we're learning that it is the factory workers who won't see a big change. And that's right? When you think about sort of the increase in production, a huge focus here on EVs, the huge demand that's still out there on the market. So as long as you remain in hyper growth mode with that, I'm not quite sure about the salaried employees and the cuts there. But the good news is that maybe if it doesn't hit the factory workers, that's what analysts are finding some reassurance about earlier this morning and, of course, last week. We can broaden out to bigger technology as well. John, I know that on a fundamental basis, 20-for-1 stock split for Apple doesn't totally make sense here, or Amazon, I should say. But actually, some analysts I've spoken to says it actually shows that the company is a little bit more investor friendly. And look, technology is 45% of the S&P 500. So if you really want to see a big conviction rally underway here for the S&P 500, maybe technology is something that you need to also show and have some confidence in as well. You change up the board and you see from a terminal chart, John, that, look, you've had 2 double-digit rallies, but there sort of has been that lack of conviction. Is this the time? Is big tech finally bottoming out enough? That is what the markets are waiting to see.
Taylor, thank you. 2 names to watch then. Tesla up by 2.9%. Twitter's been down by anywhere between 4 and 5% of the early part of trading. Tesla up by 2.9% there on your screen. The likes of Twitter we'll continue to discuss with the stock down 5%. We'll catch up with Ed Ludlow a little bit later this hour and get his thoughts on this. For the broader sector for tech, Stuart Kaiser at UBS says this: we see choppy but range-bound markets. Our preferred upside trade remains buying calls on the Qs. Stu joins us right now. Stuart, let's start there. Do you still like that part of the market?
Good morning, Jonathan. Yeah, we still do like that part of the market. Obviously, the debate has kind of shifted from valuation over to earnings, and that's going to be a little bit troublesome. But, what I'd throw out there as well is if people are worried about earnings at large, then you tend to buy the stocks that are generating them, which is probably going to be large cap tech and that growthier part of the market. So, the reason why we like Qs is much more macro. We do think inflation is going to come down over the summer. We do think rates, as a result of that, will relieve some pressure there, and we think that combination will be positive for Qs. But yeah, the debate here is about earnings, I think, less than valuation as it was about a month ago.
Well, let's talk about evidence of the macro story evolving in the direction you expect it to. Are you seeing any signs of that right now?
I would say, some puts and takes on that. If you look at the data last week, we got a strong ISM print, and under the surface, that data showed also less supplier delivery pressures. So I think the supply chain, you had some incremental positives on that side of it. The payrolls report was solid, and you didn't see that sort of inflection higher in wages. You're actually seeing average hourly earnings, trending lower. So you put those together, strong growth, supply chain, a little bit less pressure, wages not taking off, and then some headlines over the weekend about China. All of that, I think, is collectively positive, for the outlook for inflation and potentially to take down some of these recession fears. That said, CPI at the end of this week could kind of, throw all that out with the bathwater, as they say.
How would you trade Friday's number, Stuart, going into it?
We want to be hedging that print on Friday. We've had a nice bounce off the lows here in U.S. equity markets. Our economists actually see upside to that inflation print, mostly coming from airfares, which is similar to what we saw last month. But that doesn't change the fact that the headline could not be pretty. We have 65 basis points for core and over 80 basis points on the headline. So we actually like owning upside in the VIX. Either VIX calls or call spreads ahead of that CPI print. So, we do see tactical risks, even though over the next kind of 3 to 6 months, we do think the tenor is going to be improving on inflation.
Let's put a couple of things together, Stuart, a couple of things you've mentioned already. You can learn stuff from the data. You can learn stuff from how the market responds to that incoming information. What have you learned from how this market is responding to incoming data?
Well, I mean, it's really been difficult, I would say, the last 3 to 6 months in terms of market response to data. If we look at inflation specifically, the market, I think S&P is down by almost 2.5% in the week running up to CPI prints, the last 4 months. So the market has definitely not been responding positively to CPI data. If you look at the performance of the S&P from ISM to payrolls, kind of that key early part of the month, the market has also not been responding very well to that data. So it seems like the markets respond better, but we're not getting any data at all, which I think tells you the story. The market's concerned about inflation. The market's, translated inflation, into Fed hawkishness, into recession risk. So generally speaking, data has not been a friend of the market. We're hoping that changes over the next few months, but it's been a bumpy ride.
You can also learn something from how investors respond to a rally. Stuart, you've talked about that. Many people have described this as a bear market rally. Can you tell me what you're seeing, how investors react, how they reposition when we start to get this market rip a little bit, like we have done at times over the last couple of weeks?
Yeah, investors definitely voting with their feet. Last week on the rally and the week before that, we actually had seen an increase in put buying and put open interest alongside the rally, which suggested that investors were kind of hedging it as a bear market rally and trying to protect themselves if it kind of corrected back lower. If you look at where the hedging is happening, it's generally been in U.S. consumer-facing parts of the market, so consumer discretionary, retailing, and home builders. So it does seem like the market is trading this as a bear market rally on the assumption that the U.S. consumer is under pressure from inflation and higher rates, and that's how they've chosen to kind of express that view. The one caveat would be last week we did see some buying in emerging markets and in oil. And that probably has to do with obviously what's going on with Russia with the oil prices, but also some incrementally positive news coming out of China. But, big picture, I agree with you. Investors have been skeptical about this rally. They've been hedging it on the way up, and they haven't really gotten behind it. If you wanted to put a positive spin on that, people have not bought the rally. So if it does continue to move higher, it's going to drag people in. But I think it's only fair to say that investors are not fully behind this move.
We're higher right now, up 0.9% on the S&P, the Nasdaq up by 1.3%. Stu, stick with me. We've got some stuff to work through. Here's one of them. We are down by 3.7% on Twitter. That stock has a 38 handle. The agreed price between Elon Musk and that company has a 54 handle. That conversation is up next. 14 minutes into this, equities positive on the S&P 500 by a little more than 1%. One stock is negative that we've been focused on for the last 30 minutes or so is Twitter. Is down by 3.8%. Taking a look at that, here's Abby.
John, well, Twitter is down about 4% at this point, and that is well off the lows. Now, ahead of the explosive headlines that came out right around 8:55 this morning, the stock had actually been higher in the pre-market session, then all of a sudden took a sharp leg lower, down about 8%. This, of course, on these headlines with Elon Musk saying that he believes Twitter is breaching their merger agreement by not providing information about spam and fake accounts. I know that Ed will be speaking about that more, but it seems as though cooler heads are prevailing. We've had so many headlines back and forth since the April 14th bid. Overall, Twitter is down about 15%, a little bit less than 15% from that time period. But because the stock is off the lows, and to Kayleigh's point earlier, never really made that $54.20 bid anyway, it seems as though there's so much uncertainty that investors are waiting for more information. Again, Twitter off the lows, but down about 4% on these headlines.
Abby, thank you. Our good friend Ed Ludlow was asleep, so we woke him up. He's on the phone now. Ed, good morning to you.
Good morning, John. Yeah, I mean, pouring through these headlines on the Bloomberg, we know about Musk's grievance with bots, the level of bots on the platform. But as you read each headline, really what's at issue here is the mechanics of a deal that one side of the table believes is signed and pending shareholder approval and regulatory checks, and another that seems to think it's more fluid. You know, Musk is claiming that his rights as a potential owner of Twitter have been breached, and that because he's a potential owner, he is entitled to access data that would have him better understand the level of bots on the platform. He restates his right to terminate. Remember, there's a reverse termination fee here where if either party walks away, they pay the other side $1 billion. But it's the language as well. Twitter is actively, quote, thwarting information rights by not sharing more on their methodology to calculate the percentage of bots on the platform.
Ed, what are we arguing over here? Access to data or a man that doesn't want to pay the breakup fee?
It's fascinating because go back to April 25th, read we don't have to, John. I mean, you've got better things to do, but read the regulatory filings word for word. He waived due diligence back in April. And so the idea that he didn't understand how the bot mathematics works, the percentage of bots, is really bizarre because that, A, has been boilerplate language Twitter has used in regulatory filings for many, many years. But B, right early in this process, he said, I don't want to do the due diligence. This gets to the point of your question. Is he trying to walk away or is he trying to come back in with a lower fee? At the time, the consensus was he waived due diligence so that Twitter would accept $54.20 as his final offer. Because at that time, hard to see it now, but people thought maybe Twitter was a little bit undervalued.
Ed, let's talk about the final point, and that's things from Twitter's perspective. This is becoming highly disruptive for this company. You've done some reporting on this. It's really off the rails at the moment internally. What do they think of this?
Yeah, so I think internally, a lot of the work that was being done is being put on hold. They're shuffling resources. There's a hiring freeze. That's partly because of the macro environment. On the deal perspective, remember, it's only been a week or 2 weeks that Twitter's most senior lawyer stood up at an all-hands meeting and said, by law, by definition, there is no such thing as a deal that's, quote, temporarily on hold. Of course, that's something that Elon Musk tweeted. So I think from Twitter's perspective, this is agreed, and it's pending shareholder approval. And, they've just gone through their regulatory notice period of 30 days. That was lifted on Thursday last week. They're pulling in different directions.
Ed Ludlow. Ed, thank you, buddy, for getting up early for us on the West Coast and going through some of this for us. I believe actually he's in Arkansas now, breaking this down. Ed Ludlow on the move. This story, Elon Musk on Friday, it was all about Tesla. This morning, it's all about Twitter. On Friday, it was about job cuts. Job cuts at Tesla, and then he kind of pushed back over the weekend after the stock dropped by 9%. The stock is bouncing back. The payrolls report was pretty decent. It was a tidy upside surprise, yet at the same time, we're hearing all these little stories of tech companies pulling back, hiring and firing. First hiring, and now a lot more firing, and hiring freezes. Mike McKee joins us now for a bit more. Morning, Mike.
Good morning, John. Well, Twitter seems to be a sort of microcosm of what's going on here in that you get this back and forth going on. We had a lot of gloom about the economy last week until Friday when the jobs report comes in better than expected. You look at the headlines that are on the Bloomberg today, and it's all about how the economy can avoid recession. You have Lloyd Blankfein saying that let's dial back the negativity. As the economy goes forward, the question is, what is the Fed going to do? And nobody really knows because they're watching the economy, and the numbers at the moment are good enough. You take a look at what's been going on with inflation, with jobless claims, which is that canary in the coal mine, and with unemployment. And all the trends are pretty good right now. They're sort of going exactly the way the Fed wants, with core inflation going down a little bit on a monthly sequential basis, and unemployment staying very low, no uptick in jobless claims. So the outlook is pretty good at this point. What a lot of people are suggesting maybe you want to do is keep track of the financial conditions index. And you can see the Chicago Fed adjusted index there. They adjust for current economic conditions. And the economy has tightened quite a bit. And so at this point, maybe, as Larry Summers says in one of the headlines, we're seeing the Fed have an impact. But it's going to be a while until we actually know where we're going to be here. Cameron Craze has a great column this morning, often wrong and often in doubt. Either that may be the way you want to be right now.
Mike McKee, thank you. Thank you very much. I always read Cameron's work. It's always fantastic. Mike McKee there breaking down some of this. We're basically ending where we started. It's good news, bad news. And I'll end with this before I get the thoughts of Stuart Kaiser for one more final time. Bank of America's Michael Harnett said a summer of Volcker. He went on to say this: no Fed until the Fed is done. And in 2022, that requires a negative payrolls print. Stuart, it's fantastic to have you with us. I just want a final word on that. You're a little bit more constructive than most. When I speak to those who are constructive on this equity market, it often involves some kind of Fed pause, some kind of Fed reversal. In Hartnett's words, no Fed until the Fed is done. What's your thought on that?
Look, I mean, our view is that once you get past that September meeting, they can not pause, but maybe, shift from a 50 to a 25 basis point kind of hike rate. Look, the economy was going to be slowing this year, even if the Fed didn't hike rates, right? You had a massive pullback in fiscal spending, and you grew real GDP almost 7% in the fourth quarter of last year. So the data was going to be slowing, as we went through 2022. And at times, that data has actually, looked recessionary in some pockets, and in other places looked very, very strong. So our view is not that the Fed is going to need to drive a recession to get inflation under control, because we think inflation is going to come down as the year progresses. That said, if you're of that view that they're going to need to drive a recession, then clearly you're going to be very, very worried about the earnings outlook, and you probably think there's another leg lower for equity markets. So I guess from my perspective, the economy was going to be slowing. Some of that slowing has perhaps been accelerated by Russia, Ukraine, by China, as well as by Fed tightening. But ultimately, we think inflation will come down over the summer, and that'll take some pressure off the Fed, and hopefully, as a result, take recession odds a little bit lower in the minds of investors.
Stuart, out of interest, what do you think the consensus view is right now, and how expensive do you think it is from an options perspective to have that consensus view?
I think the consensus view probably is that this is a bit of a bear market rally. We're probably trapped in a bit of a range, let's say between 3,800 and 4,200. And a lot of macro investors are going to be trying to trade that range, at least for the foreseeable future. What gets you out of that range would be probably our inflation view, coming to pass over the summer, and to the upside, and to the downside, it would be, frankly, that it doesn't happen. And it looks like the Fed needs to kind of, tighten pretty considerably. What's expensive? Look, options are generally speaking fairly expensive across the board right now. But in our view, you can own some tactical upside in the VIX to hedge yourself. And if you need to hedge, and if you're worried about that recession outlook, then I think you probably target small cap as the way to kind of hedge a slowdown in those growth risks. We think that vol looks relatively attractive, and we think that's the part of the equity market where you'll see earnings get hit first if they do.
Stuart Kaiser, awesome, buddy, as always. Stuart Kaiser there from UBS. Your equity market positive 0.9% on the S&P. On the Nasdaq, up more than 1%. Your trading diary up next. Around about 26 minutes into the session, there is a $29 billion name called Twitter getting all the attention. Let's not take our eye off what's actually happening. Let's move in this equity market, up 0.9% on the S&P, the Nasdaq 100 at 1.28%. The divide on Wall Street at the moment, Is this a bear market rally, another squeeze, or something more durable? Morgan Stanley on the one side, and as you know, JP Morgan very much on the other. That's the price action. Here's the trading diary. You'll hear from the Prime Minister at 1 p.m. Eastern Time. He faces a confidence vote a little bit later. We get rate decisions from the RBA and RBI on Tuesday and Wednesday rather. ECB rate decision on Thursday, and another round of jobless claims as well. And then finally, the CPI report.